Hi everyone, this is part 3 of the video for chapter 2 for financial management. All right, so we're talking about Warren's financial statements, specifically the balance sheet or what is often referred to as the statement of financial position. We have our assets at the top. They're covering non-current assets first at 500,000 minus accumulated depreciation. We've calculated depreciation again in accounting 1 and accounting 2, and we're going to be talking about depreciation a little bit more in just a moment. Then we have our current assets, cash, accounts receivable, inventory, and such to give us total assets of 745,000. Then we have our share capital, as you saw coming from the previous stage. We've already talked about this to give our equity of 355,000. Then we have our non-current liabilities, and our non-current liabilities are made up of long-term borrowings for 200,000. Maybe it's a bank loan. Then we have something called future income taxes payable. This actually used to be called deferred taxes. We're actually going to be talking about this in a minute as well in relation to the accumulated depreciation. Then we come down into our current liabilities, and we're talking about regular accounts payable, short-term borrowings, borrowings that are paid off within the first year or the next year, accrued expenses. We discussed this already. A lot of times expenses that we know are going to happen, but we haven't received the bill yet, we set them up as accrued expenses. So for example, we would, if we knew our heating bill or a heating expense was supposed to be $200 for that month and nothing's been recorded yet and we haven't received a bill yet, we need to put that 200 in. So we would call it heat expense or utilities expense, and then the other side of the equation, instead of it going into accounts payable, it would actually go into an account called accrued expenses or accrued expenses payable. Then we have our current portion of the long-term debt. So of the loan that we got from the bank under long-term borrowings, what portion of that is going to be paid off within the next year? And that's actually listed under our current liabilities. Then we come to the item called current income taxes payable. And again, we're going to be talking about that in just a second in conjunction with future income taxes payable and accumulated depreciation. So anyway, that side of the balance sheet adds up for total equity and liabilities of $745,000, which of course matches our asset total of the same. Okay, so as I promised, we were going to be talking a little bit about taxation, depreciation, and what's called CCA. Okay, so as for corporate tax, that amount varies depending on what province you're in. There's a provincial portion and there's also a federal portion. Taxes for small businesses, if your profit is actually less than 400,000, there can be a benefit or a savings of up to 25% for a small business deduction. Then we have our regular business expenses, which we've talked about before as our operating expenses, our cost of goods sold, regular operating expenses such as salaries or wages, our selling and administrative expenses. Financing costs, we've talked about this as well, which is our interest expense. So if we have a loan, we would be paying interest expense on that loan. Business losses, so if you actually have a net income of a negative or a net loss, that value can actually be carried forward for income tax purposes to help reduce your taxes payable to the government for future years. But let's talk a little bit about capital cost allowance. Um, this is a term that's actually put in place by Canada Revenue Agency or CRA. and it actually is what the government allows us to deduct for tax purposes, as opposed to us being able to decide as a company what depreciation we're going to put through. So maybe for our company books, we put through depreciation at a straight line, but the government has other ideas. They've done a lot of research in this area, and they know that, if you have a piece of equipment, the average life of that equipment, and they're telling you that you can deduct a certain amount per year for that equipment. And that's it. You're not allowed to deduct any more, even if you decide to do straight line or double declining balance. Okay, so don't want to get into that slide. Here's a good one here. There's actually a good example in your textbook as well that I'd like you to look at. And it's capital cost allowance is actually started on page 59. For example, there's one here that it says that the CCA rate, or the capital cost allowance rate for general machinery, which falls into a class called Class 8, has a maximum rate that you're allowed to deduct in any given year of 20%. Buildings, because buildings last so much longer than equipment do, you're only allowed to deduct 4%. Okay. So if you look on page 60, we're actually looking at trying to do an example of a calculation for the capital cost allowance. The example that it's given you is saying that the asset that they're talking about um, is worth $100,000. So the value at the beginning of the year when you purchase it is $100,000, and the rate that the government is allowing you to deduct is 50%. And as you can see, either in your textbook on page 60 or on the current slide, for some reason, it's only showing in that first year, instead of 50,000, it's showing 25,000. The reason being, as you can see down below, it says income tax regulations allow only half of the CCA rate during the first year. Okay, so the reason they do this is to try to make it fair. So whether you buy your piece of equipment 3 days into the year or 3 days before the year ends, you're still only allowed to deduct half of the capital cost allowance for that first year. So that's why it's 25,000. So that's the amount that would be put through. Then in the second year, it's showing that it has a value at the beginning of the year at the 75,000, which is the 100,000 minus the 25 that's been deducted off for capital cost allowance to give you the 75. And then half of that again is the 37,500, and so on and so forth, until the asset is completely depreciated. Okay, so now they're showing you a problem, problem solving example 2.3 in the textbook, and I'd like you to give that a try. I know it actually shows you the solution, but I'd like you to have a look at it. And what it's doing is trying to show you the difference um, between the capital cost allowance and the depreciation. Then it actually goes through a self-test exercise of 2.3. Give that a try. And again, remember, no matter how much you calculate in that first year for the capital cost allowance, you are only allowed to deduct half of it. So for example, 40%, $40,000 is 16,000, but you've got to divide that by 2 so that you're only allowed to deduct the CCA of 8,000 in that first year. Okay, and as you can see, compared to the straight line, every year is a little bit different. So under depreciation, straight line is showing 20,000 for the 5 years, but the CCA rate is showing 25,000 in the first year, 37,500 in the second year, so on and so forth, down to in the fifth year, or the last year of life of that asset is $4,687. Okay, so the next category in the textbook is called current assets. Have a look through that. We've talked about that quite a bit, as well as your equity. But now if we get into non-current liabilities. So because the capital cost allowance and the depreciation are different, the amount of tax that is calculated is going to be different. So the amount that you're allowed to put through for tax purposes for the government is a certain amount, and the amount that you're actually allowed to put through for your own company is a different amount because you're using depreciation versus the CCA rate. So if you have a look at the slide that I'm showing you right now, you're going to see the accountant's worksheet is showing 25,000. That was the CCA that we were able to calculate. So that's the amount that's going to go through for tax purposes. But according to our depreciation calculation, we're only going to put through depreciation of 20,000. So therefore, profits before tax is different. 75,000 on your accountant's worksheet, and this is taking in the taxes. And when we're looking at their statement of income or our profit and loss statement, it is showing 80,000. So taxes, this is where we're showing what our current amount that we're going to put through. So as for our profit and loss statement or our income statement, we're going to put through 40,000 for tax expense. Okay, 50% of our 80,000. But coming over to our statement of income, we're going to put through 50% of the profit for before taxes, which is 75,000 on our accountant's worksheet. Then we're going to show, but we owe 40, but we don't have to pay the government that last 2,500 until the future, when our CCA rate drops, and then it's going to flip the other way. We're going to have more tax going through our profit and loss statement and less going through for our income statement. And that's when it's going to even out. Okay, so the future amount of the 2,500, that is what is going to show up right here, where you're looking at, I'm sorry, it is, I thought they had a picture of it showing where it went through. Okay, so that is, they're not showing the same amount for some reason on this slide, but the here, future income taxes payable. That's where that 2,500 would show up, is right there on that statement as the amount of future income taxes that's payable. And then the amount that's currently payable, that's what would show up here. They, for some reason, their slides are not flowing properly. See here, the 37,500, that would show under your current income taxes payable, and the future income taxes payable, which is under your long-term liability, would be your 2,500. Okay. Okay. So now they want you to do an example. Have a look through the example that they're showing in your textbook, which is the one that I just went over, and then they're asking you to review problem solving example 2.4, and then they're asking you to have a look at the self-test exercise 2.4. Okay. Then the only thing left for you to do for this exercise is to have a look at problem solving example 2-5 on page 66. They're creating a statement of financial position. They're giving you the account balances. Have a look at those balances and see how they created in proper form the statement of financial position. And then they're asking you to do the same thing again in self-test exercise 2-5. They've given you a list of all of the accounts and they'd like you to create the statement of financial position. And as I stated earlier, I have included the answers for all of the self-test exercises on the D2L under the content for Chapter 2. Hopefully this video has helped. If you have any questions, we're definitely going to be going over all of this information again, especially to ensure that you understand what's going on between the capital cost allowance and depreciation. And if you have any questions, we will definitely be going over it in class, and I'd be more than happy to answer your questions either in an email between now and then or in class on that day. Sorry, this video was a little bit longer, 16 minutes to be exact, but I hope it has helped clear up any questions you may have. Thanks, everyone.